If your mortgage rate starts with a 5 and you've been unsure whether you should refinance, look for a cashback option, or maybe approach a HELOC, this episode's for you.
Will make sense when to refinance your property, when not to. We'll also look at different cashback offers versus a lower interest rate and what makes the most sense.
Before we get started, I'd like to give a huge shout out to Le Studio Canes, a recording studio located in the South Shore of Montreal. Whether you're looking to record a podcast or film some short form content, this is the place to be. Check them out on their website at lestudiocanes.ca. Today we're with Mathieu Alexandre Poupart from Orbis Mortgages. How are you doing today?
I'm doing really good, thanks.
Excellent. I'd say that in my career, we usually see buyers start with maybe a first-time purchase of a condo, then possibly move up to a house, and somewhere along the way, they get the itch to start buying revenue properties and start becoming real estate investors as well. Is that what you'd see typically as well?
Yeah, absolutely. I mean, I've felt it myself, but with many of our clients, when they understand the power of increasing value in a property, it's an amazing tool, right? So as soon as they get the itch, they want to know more.
And what would you say? I know a lot of buyers reach out to me and say, LJ, what about the rate? What about the rate? I know there's so much more to it, but I think that people are tired of hearing it from me. So what would you say the other points that people should be looking into when deciding on the mortgage for themselves?
Yeah, so I mean, the cliche kind of saying is date the rate, marry the house, right? So it's important to know that you're not necessarily going to lock into a 5-year term. There are 1, 2, 3, 4-year options as well. And there's also, going fixed or variable. And depending on your situation, depending on your objectives and what you anticipate you might do with the specific property, those are all going to be potential options. There's not one bad one. And really, we need to understand what the client's objectives are before we can properly guide them in what might save them the most money.
I think that's the most important thing. Taking the time to understand what truly the client's objectives are. And that's where I think a lot of mortgage brokers and even real estate brokers skip a super important step. The reality is that we're here as consultants, as coaches, as guides, but we can only do our job if we truly understand what they're looking for to get them to that next chapter of life, whatever that may be.
Right. And it's really important that the client be comfortable in understanding why they ended up choosing a 3-year fixed or maybe a 5-year variable, so that they're properly understanding the strategy and they don't wake up 2 years later and be like, hey, why am I on a variable and why is the rate increasing, or whatever the situation may be. So it's really important for them to understand why they chose a specific option. Because at the end of the day, it's them choosing, right? I'm giving them the options, or we're giving them the options, and they're the ones that are going to choose the strategy that they're most comfortable with.
100%. I think we're all coming off of the 2022 to 2024 rate increases that a lot of us were sitting in, and myself included. We took a variable rate because for the previous decade, it had been the cheapest option on the market. And all of a sudden, we see these huge spikes, and everyone starts to get a bit bitter about these decisions that were made when the historic information and data that we had did make that the best option realistically. But again, like anything, things change, and we have to be prepared for these changes and understand that risk that comes along with that.
Yeah, and we were, privy to relative stability when it came to rates for the last 10, 15 years. And when COVID hit, at first, obviously the rates plummeted, which was great. But ever since then, it's been up and down, up and down. Economists have no idea where rates are going. And I don't blame them. It's really difficult to kind of understand and make sense of what might happen in 6 months or a year. It's a little easier to say what might happen at the next rate announcement, but beyond that, there's so many variables that will dictate what will have to happen that it's impossible to know. So there's a lot more uncertainty right now, which does make it a little trickier to choose or to be confident in your choice of a specific rate.
100%. I'd say this year in particular, 2025, it really felt like every morning, especially in the first half of the year, we were waking up to a new tweet from President Donald Trump, and that could make a huge swing in where the CMB rate was going to be, where fixed rates, variable rates, what might be happening. And then the jobs report that is also always arguably a crapshoot. We don't know where it's going to go, how it might happen. I was doing some research on that recently, and we find out that they interview, I think, 56,000 households in Canada to determine the jobs. And while that's not an insignificant number, when we look at our population of over 40 million people, to simply call around to 56,000 homes to understand what the reality of the market is, I think is incredibly unreliable.
It is. And, we joke around and we call it the random number generator. But I think what we do have to look at is the overall trend. And that does have a massive impact on where rates go. Just a month ago, economists were calling that the Bank of Canada was not going to cut rates anymore. It was the end of the cutting cycle. And now in the last week, the odds of a rate cut at the next announcement skyrocketed. We're essentially at a 100% chance of a rate cut on September 17th. And I think it's like 92% at the next announcement. So 2 more rate cuts, and that can change, it might end up very well changing. And we might only see 1 rate cut, but it's just to say that it's very uncertain right now. So it's important to properly understand the dynamics of the different options and then to really choose the one that really suits your needs best.
So I guess if we start to get into some real life examples for, let's say we're talking about a first time buyer right now, let's say that it's a single income and they have employment income, so they know exactly how much they're going to be making every year. They might have a $5,000 a year bonus, but they have pretty consistent income levels. Looking to buy a condo somewhere in the greater Montreal area, we'll call it a $450,000 budget. What would be your recommendations in this kind of a scenario?
So I think for most buyers, they'll tend to prefer peace of mind, right? And that's the biggest advantage offered by a fixed rate product is peace of mind. Typically, you're paying a premium to have a fixed rate as opposed to a variable. And so you get the peace of mind. And now what's important with the fixed rate, because peace of mind is great and all, but is to understand the potential cost of breaking your mortgage early. So what that means is if you take a 5-year fix and after 2 or 3 years you decide to sell the property and not necessarily buy another one, then you'll be subject to a prepayment penalty, which can be massive. The banks are smart, like they know how to make their money, and they also want to protect themselves from rates coming down quickly and everyone breaking their mortgages to sign up for a new, better, lower rate. So they impose a prepayment penalty. Now, there are lenders that offer less
Aggressive.
prepayment penalties, exactly. But it's really important to know that when you're going to a fixed, it's more restrictive compared to a variable rate product, right? And with the variable rate product, it's not for everyone because you need to be willing to take on the risk. You're the one taking on the risk, not the bank with the variable rate product. And it was all fine and dandy for the last 15 years until we, got to COVID and we saw something that no one really thought would ever happen again, where rates skyrocketed almost 5% in a year and a half, and it costed a lot of people a lot of money. So if you're not going to sleep well at night because the Bank of Canada might end up increasing rates, then the fixed rate is probably for you. And then it's about deciding, do I go with a shorter term fixed rate to kind of hedge or protect myself against potentially breaking the mortgage early? And then it also depends on, do they anticipate being able to refinance the property eventually? If they sell, is it to buy another property? Because that's a way of avoiding the penalty, right? You could transfer the mortgage to the next purchase in most cases. So it's just really important to have these discussions to understand what do the next 2, 3, 4, 5 years look like with this specific property, and to just be mindful of the potential cost because the rate is not everything.
It's funny you mentioned that because I always tell the clients as well, if you're going to lose sleep over this, that is not the right option for you. You have to know what you're looking at. And I go to bed every single night very comfortably knowing the decisions that I've made and how I help people. And if you're unsure about your mortgage rate, that is super impactful and super important. Saving 30 basis points to have peace of mind, or potentially paying 30 basis points more to have peace of mind, is a huge win for yourself. And you got to keep that in mind. Now, would you say that most first-time buyers are going with an insured product or they're going conventional?
It must be close to 50-50, at least for my clientele,
Yeah.
where a lot of clients end up putting less than 20% down on their first purchase. And what's interesting is as long as the intention is to live in the property, and so as long as you're planning on living in the property, you can put less than 20% down. So it doesn't only have to be for your first purchase. But it's true that a lot of first-time home buyers are, 20% can be a massive amount of money. So most people, not most, but a good chunk of people will end up putting less than the 20%.
And I think it's important that you mention that because a lot of times people have heard that you have to put 20% down, and that's not true. That is not real. That is not the case in Canada. We have these mortgage insured products that are specifically made for people putting less than 20% down. And what I've told people for years is that if you are going to wait another 3 years in order to save that 20% down, more times than not, you're playing a game where you're always trying to save enough to get to that new price bracket, and the property that you could have bought 3 years ago would have made way more in appreciation over that period of time than what you lost in saving over it. So if you can get into a home today and you can live comfortably, this doesn't mean obviously make yourself house poor and go way above what your means are, but if you can do it today and put less than 20% down, it is invaluable to get into the market, start riding the wave of the market, and be a homeowner, and so you can start taking advantage of all the benefits that come along with it as well.
Yeah, I completely agree. And what's really interesting is that this year the government allowed first-time homebuyers putting less than 20% down to amortize on 30 years instead of 25. So that helps to really budget properly and to make sure it helps to lower your monthly payments, right? So you don't feel super tight and you can kind of increase your borrowing capacity without feeling tight, which is the most important thing.
That was such a huge win. I remember speaking to clients about that. We can go up to $1.5 million now. There's been so many changes over the last 12 months, realistically, that have impacted the way people can finance properties and get into the market that have been super interesting. And a lot of the products they came out with in the last 12-month period have actually been great. And I don't say that very often about the products that we've been getting as Canadians, but over the last 12 months, they've actually made some interesting decisions to really help Canadians get into the market, which is ultimately all that we want. Allow more Canadians to be homeowners in our markets so that they can start building equity. As we know, owning a property is the easiest way, the best way to start developing equity and have a retirement plan. Most Canadians really rely on the equity they've built in their first property or in whatever property they're at for the retirement, whether that's eventually to use with a reverse mortgage that we can talk about another date, or to eventually sell and have the money to live with family member in a home, whatever that might be. That's truly their nest egg and the basis of their investment.
Yeah, the 30-year amortization helped people qualify for 7 to 8% more on that first purchase, which was massive. And another product that the government implemented was the FHSA, the First Home Savings Account, which is another honestly incredible product. It makes, if you're planning on buying a home like that, I'm not an accountant, but in my opinion, should be the first account you start contributing to take advantage of those tax breaks and to help you save towards that first purchase.
I actually interviewed a financial planner probably about a year ago now when the product had just come out. And really, the idea was that you need to stack these products on top of each other and create a waterfall effect, right? Because if you contribute to the FHSA and then take your tax return on that, contribute that to your RRSP, and then take the tax return on that, and then throw that into your TFSA, you really get to use that waterfall effect on all three products to really take advantage of it. Because as Canadians, we do pay so much in tax that you need to take advantage of the gifts that they give out. And there's not a ton of them, but you need to make sure that you're becoming educated, always having your pulse on what products are available to you and taking advantage of them if you do intend on buying something or not. Because with the FHSA, even if you don't end up buying a property, you can roll it into your RSPs eventually. So there's really, it's a win-win situation here.
There's no downside. And, another interesting thing that they added was allowing anyone who has more than 35K in their RSP to go up to 60K that they can withdraw from their RSP. And another thing is that instead of having to reimburse the RSP immediately after purchase, or in that first year after you purchase the home, you can do it in the next, or start in the next 5 years, which is huge as well. So we'll see if they extend that, because I think that's a temporary kind of offer right now, but I suspect they're going to end up extending it. So we'll see how that goes.
Given where the economy is, I think that anything temporary right now is probably going to get extended a little bit to help amortize what everyone's feeling. So now let's move over to maybe somebody buying their second property. Let's say they're trying to get into a single family home now, maybe in the $900,000 range. How would you say most clients are currently going about that product?
There's a good chunk of clients looking at refinancing that first property. So if you've owned a property for 5 or 10 years, chances are you've built up a good amount of equity, especially over the last 5 or 10 years. And that means that you have this essentially cash sitting in value in your first property that you can then pull out and use as a down payment on the next one. So they'll either look at potentially selling the first one to buy, so using the profits as a down payment on the next purchase. But we have more and more clients who are looking to refinance, rent out the first property, and then to use that amount for the down payment. And there's a few different ways to go about refinancing, and it's important to plan ahead because you want to make sure that your mortgage product is well suited to refinance, to not cost you any extras, because it's doable without actually costing you anything more.
So let's break that down a little bit. What would the options be? What do you see people doing? I think that people always hear about all these strategies, but then they never really hear how to execute on them. And I think that's what really our viewers are most interested in. So what would the options be there?
Yeah, so number one, the most important thing to be aware of is that you can refinance up to 80% of the market value of your property, right? So if you have a mortgage that's 50% of the value of your property, you'd have 30% available to pull out as cash. Now you need to qualify for that amount, so it'll be based on your incomes, hopefully your very little amount of debt, and then you can use that 30% on the next purchase. And what lenders will do is, even if your current property is not rented out, they're still going to consider the market rent value of that property because they know your intention is to rent it out. And so that'll help you qualify for the refinance, but then also for the purchase, which is really, really interesting. And so a refinance, you have to make sure that you're not locked into a 5-year fixed with a lender that won't allow you to refinance, because sometimes the best product, or the best rate, I should say, on the market comes with restrictions. So we need to plan ahead to make sure that you can either add a second mortgage with that same lender and not break the first one to pay that prepayment penalty. Or perhaps you can have a lender that allows you to add a second mortgage where they blend the rates, so they give you an average weighted rate. And the idea there is that you're just not paying that prepayment penalty, because we spoke about the fixed rate penalty earlier on. And what I tell clients often is, once you've paid a penalty on a fixed rate once in your life, you'll probably never go fixed again. No matter what your risk tolerance is with the variable rate, the prepayment penalty on a fixed can be really expensive. So it's important to avoid that at all costs.
I think that's huge. Now, I think that we really have to highlight here the fact that a lot of the times, because people are so set on getting the absolute best rate that they possibly can, and I've seen people nickel and dime a banker or mortgage broker for 5 basis points and entirely send the file somewhere else. But what they don't realize a lot of time is that that 5 basis point savings is coming with a ton of restrictions. If you can't port the mortgage, if you can't take a second product on it, if you can't do all of these things, well, it might end up costing you way more than that 5 basis points that you were saving over the course of the next 5 years. So you really have to be clear about what your intentions are. And obviously people can change, situations can change, but you want to be zeroed in on what your plan is today so you don't get hit with these restrictions after that end up costing you way more, because ultimately you want to have the flexibility. If flexibility has a price, and if it is that little of 5 basis points or maybe even 10 basis points, it's definitely worth it. You don't want to find yourself stuck in that kind of a situation.
Yeah, so good questions to ask are all the restrictions. Can I port, like you said, so transferring a mortgage from the sale of a property to the purchase of the next? It can be, what is the prepayment privilege? Like how fast can I prepay a mortgage? Can I make more than one prepayment a year to pay towards the principal and lower that interest I end up paying every year? Because it's not the same for every bank, right? So interest is one thing. We all love a low interest rate, and you really have to understand the terms and conditions that come with that lender or that product, because sometimes one bank offers 2 or 3 different products and they all have different types of restrictions, but we have to look ahead and try to kind of minimize the total cost of borrowing. And sometimes that doesn't come as a penalty. It comes as just savings on interest because you were able to make multiple prepayments, but you're with a bank that only allows you to make one prepayment a year.
That's super important. I was actually running a scenario for a client yesterday because they said, hey, LJ, I've heard about maybe putting a bit more capital down every single month. Let's say I had a car payment that was about $360 a month. The example was on a $300,000 mortgage roughly at a higher interest rate, just for full transparency. And they're like, I'm planning on finishing paying down my car in the next 6 months. If I were to take that same payment that I was making and putting it to my mortgage, what do you think that would do for savings? So I ran the scenario and I was shocked to find that if they were on a 30-year mortgage, they would save 10 years on the amortization period by just making that $360 capital payment. Additionally, the initial principal and interest payment was about $1,800, just for context on the math here, and they were saving $134,000 of interest over the course of that loan.
It's crazy because, and the truth is, when you have, let's say, a 25 or 30-year mortgage, those first 5 or 10 years, you're paying mainly interest for the most part, right? So it's a very small amount of principal that you start paying down. And then gradually, as you lower that amortization is when you really start to pay down the mortgage faster. So making prepayments can greatly, like you just used explained in your example, reduce the amount of interest you end up paying overall. Because sure, the cost of a house might be, 7 or 8 or 900,000, but in reality, it's hundreds of thousands more when you calculate the interest you'll end up paying.
100%. So now I guess let's pivot a little bit to somebody now going up into a larger price bracket. Let's say, let's go with a very specific example. The person has their home now. They're kind of set. They're happy. They consider upsizing home, but they realize they don't really need to. So let's make a more financial decision here. Let's buy an investment property. Right. So now we have some equity again built up in this home that we have, and we're looking to buy an investment property. Let's call it $1.3 million, small, or actually pretty good size fourplex, maybe even a 5 or 6plex. We're really getting into that game. How would you suggest people potentially look at financing that?
Yes, the refinance when you can is a great opportunity to take advantage of the equity you have in your home. And the truth is, with a rental property, what's I find like the most important kind of thing to understand is that different lenders will qualify you for different amounts when you're borrowing to buy a rental property and when you own rental property. So let's say that client still owns that first condo as a rental, that'll impact the amount they'll qualify on that next investment property. And you'll qualify for different amounts with different lenders. So they all use rent or calculate rental income differently. And so if you just walk into your bank, let's call it one of the green banks, you might qualify for, 1.2. But if you walk into a red bank, you might qualify for 1.3 or 1.4, just because they consider the rental income differently. And that makes a massive difference, especially when you're looking to buy a rental property, because you need to maximize that borrowing capacity.
And then another strategy that I've seen people use as well in the past is, hey, let's take a home equity line of credit, or let's refinance the home, and let's be very good with all of our accounting, because CRA will check this. And by taking that additional loan to purchase an investment property, the CRA allows you to deduct all interest associated to that, because it is in the premise of generating revenue and creating business. It's like a business effectively. So if you can really zero in on having your accounting dialed in and show where the money came from, what the interest associated to it is, then you'll be able to deduct that interest as well as the new mortgage. So you could effectively, if the numbers make sense, have a property that is 100% financed, where you didn't go out of pocket initially for any of it, and you're building equity over time. You have the tenants paying down the loan on it, and you really start to grow your portfolio that way. Again, I want to stress the fact that it has to be generating revenue and that you have to be really good with your accounting in order to take advantage of this. But there are ways of using the system to your advantage, simply put. And like I said before, you need to do this as much as possible to come out ahead because of the way the tax code is structured in Canada.
Yeah, it's really important. So it's worth the investment to speak with your accountant before getting into the project to understand, like, if we refinance, how can we deduct the interest we pay, because we're creating a new expense and you don't want to bear that without, taking advantage of the deductions that are available to you.
Great. I just took a look at the time and I realized that we are actually running out of time for this video in particular. If you've been enjoying everything we've covered so far, there's still so much more to hear about. We're going to be splitting this video and I'll be bringing you part 2 in the next couple weeks.